Okay, Mocama Sunday service. Most traders lose money because they don't follow these risk management rules. And that's what we're going to be talking about today. How not to lose your savings trading stocks. All right. So, what does it mean to blow up a trading account? What it means typically, at least for me, is like losing anywhere from 25 to 30% of your account or more. The reason why I'm not saying 100% is because I feel like for everyone, no one expects to lose all of their money in their account. And there's a point at which people go, you know what, maybe this isn't for me. I saved up this money in my savings account and I don't want to lose it all. And then once people hit that 25% or a little bit more, they're like, you know what, maybe I should stop trading. Maybe I'm not good at this. They start losing a bunch of confidence. And even especially if you have a significant other or a wife, the wife sees the money going out the account and it's like, maybe you should stop doing this and just put it in a savings account or a high yield interest account or something of that nature. So that's what it means to blow up a trading account. Not just being down, but being down so much that you don't think that you're going to be able to come back from it, right? So what are the key causes to this? Number one, taking on too much risk. Number two, not setting limits on losses or setting stop losses. And then number three, trading with too much emotion and not a plan. All right. And so before we get into how you can avoid blowing up your account, I always want to distinguish between investing and trading. We are talking about trading accounts. Investing is long term. Things that you want to hold for ideally 5 years or more. At least that's my standard for investing. I try not to look at my investing account too much because these are stocks that I've done fundamental analysis on. I've gone into their earnings. I think they're companies that are going to be bigger in 5 to 10 years. So these little short-term dips or this noise in the market, I try not to let that I try not to let that affect what's in my long-term like retirement accounts. Trading, I have a separate account for my trading. By trading, I mean short-term. Day trading could be getting in and out of a trade within a day. Scalping is even shorter than that. Swing trading, which is typically what I do, are trades that you could be in for longer than a day, up to 3 to 4 weeks, right? So that's what I mean by trading. And this is more so for trading versus your investments. So here are the 4 rules that I try to abide by to avoid large trading losses. Number 1, I always set stop losses. And even if you set stop losses, some people ignore them. So don't ignore them. This was your plan coming into the trade. So this was before you got emotional. Ideally, you had a trigger, you had a target one, and in case things went well, and then you have a stop loss in case things go bad. You should know these 3 things before you even enter a trade, right? Where are you going to get in? Where are you going to get out if things go well? And where are you going to get out if things go badly or poorly, right? So a stop loss is a tool to help protect your money by setting a limit on how much you're willing to lose on a trade. So there's 2 ways you could set a stop loss, and I'm going to go over this later in the video. You can make it automated. If you looked at some of my prior videos, you've seen how I've automated my stop losses. Number 2, you can set stop loss alerts. And that's what I do now. But I caution you, if you're not someone that can look at the market when that alert goes off, then maybe you should think about automating your stop loss. The bad part about automating your stop loss is that they're going to give you market orders to exit. So there might be some slippage, or you might get out at a lower price than what you intended, depending on what the spread is in your option or stock, depending on what you're trading or what vehicle you're trading in, right? So I would suggest doing stop loss alerts. But if you're someone that has a 9-to-5 job, when the market is open and you can't get to your account or you can't get off that meeting or whatever you're doing, I would suggest automating your stop loss, and then maybe not trading options or stocks that have large spreads so that you don't get a bunch of slippage when you get out of the market if the spread between the ask and the bid price on that stock or that option, if it's very tiny, or if it's a short amount, like a couple of cents for options, then it's not the worst thing in the world to set a market stop loss. Number 2, position sizing correctly. I probably should have made this number 1 because stop losses, like if you've been trading for a decent amount of time, you should know about stop losses, right? That should be like something that's most people who've been trading for a period of time know about stop losses, but there are some people that have been trading for a period of time that don't know about position sizing. And this is all relative to your account size. So position sizing is choosing how much money to use for each trade. It helps keep your money safe by not putting too much in one trade, right? Don't put all of your eggs in one basket, right? So this is just an example how I'm position sizing right now, right? My account size right now is approximately $46,000 in my trading account. This is what I trade with, right? So my desired account risk is about 2.5% for trade. So there are some people that say it should be 1%. And the reason why they say 1% is because if you have a trade with an edge, or you have a system or a setup with an edge, meaning that you win more than 50% of the time, right? You want to give yourself enough swings, enough at bats, since we're in the World Series right now. Go Dodgers, right? Giving yourself enough at bats. So if you're only risking 1% of your account on every trade, then you're going to have 100 swings, right? And if you have a system or a setup with some edge, then if you got 100 swings, you should come out on top. Versus if you had a desired account risk of 10%, you only got 10 swings. And there are times where you could go on a losing streak and lose 5 or 10 in a row, where you're down 50%, 60% of your account, right? And that's what you don't want to do, because that's how you blow up an account. So depending on where you are starting, I'm starting at $46,000. So my account risk is at 2.5%, which means I get like almost 50 swings at bat in terms of my system, right? So if I lose 5 in a row, I'm still not going to lose more than like 10% of my account, and I can come back from that, right? What I can't come back from, if I lose 5 or 10 in a row and I'm wagering 5%, 10% of my account, I can't come back from that. That's how your account gets blown up, right? And so this is something you should be doing before you enter trades. I know that I want my max loss to be $1,150 per trade, because that is 2.5% of $46,000. And the reason why I got that is because, right, like my stop loss, at least with my system, I set my options at a stop loss of 25%. If I lose 25% of my option, then I get out of my trade. So that means that per trade, my maximum budget is $4,600, right? Because I know I'm going to get out of that trade in or about 25% with my stop loss. So if I risk $4,600, I buy $4,600 worth of options, and I get out after losing 25%, my max loss is going to be about $1,150, which means that I'm not going to be risking more than 2.5% on every single trade, right? So that's position sizing. So number 3, scaling into a trade. Some people disagree with this, but this is also a risk mitigation tool. For instance, that $4,600 that I talked about, I could use that entire budget at one particular level. But what I do is I would rather put a portion of it at one level, and then put a portion of it at a level below it, and then maybe put another portion of it at a level below that. So I'm scaling into a full position. So if it's at a higher level where I have a more aggressive entry, I might not put on that full $4,600. I might only put on like $1,400 of that $4,600, right? And then if it goes a little lower, I'm going to scale in a little bit more so that way I have different risks depending on the levels, right? Um, and so this is just like how I would scale in or how I'm scaling in right now. So here's what we just talked about, that $4,600 budget. And then if I'm at the aggressive or the moderate level based upon my charting, then I might put 30% of my budget there, or as I said, around $1,400. And then if that stock pulls back even more, then at a more conservative level, and I usually mark these off based upon volume spikes right now, right? Something that I've kind of added to my trading system is inside of my zone where I want to buy, where are the big volume spikes at a little bit lower in the zone, and that might be my conservative entry. And so I'm going to put more money on that because, right, there's a better risk reward ratio if the stock comes down even more, if it's already exhausted, or if all of the sellers have been selling for so long and I think more buyers are coming in. That's going to be a less risky level, so I'm going to size up if it gets further down, right? This is another risk mitigation tool. Here's another example. Instead of what I do, I do have 3 levels, but recently I've only been entering in at a more aggressive or a moderate level wherever I see a volume spike using a volume profile indicator, and then a conservative level. So I'm essentially going to scale in twice in terms of what I'm doing now. Some people scale in 3 times. They might have an aggressive level where they put 25% of their budget, a moderate level where they put 25% of their budget, and a conservative level where they put 50% of their budget, right? And then if you do this ahead of time, if you do this on the weekend before the market opens, you should already know what your budget is for those particular levels, so you're not scrambling when a trade is triggering and go, how many options am I going to buy? How much stock am I going to buy if you trade stock, right? Or if you're trading futures. You should know, hey, my budget for this level is $1,150. So let's say if an option is priced at $1.10, that means for my aggressive level, I can buy approximately 10 contracts, right? Because that's what my budget says. So that way, you know, from a risk standpoint, you've already done the work ahead of time to figure out what you should be doing to mitigate your risk. And a lot of that is just making sure you don't risk so much on any one idea. As I've told everyone previously, I am guaranteed to lose 3 to 4 out of every 10 trades. That is my system. My system has a 60 to 70% win rate. So what does that mean? That means that, hey, I'm going into this trade knowing that there's a 30 to 40% chance that it could go against me, right? And the only way that I can be on the right side of that statistic is by trading enough times. If my budget or my account risk is too high, I'm not going to give myself enough trades to be on the right side of that statistic. So this is why scaling into a trade, why position sizing are incredibly important, right? And this is something that I'm going to give everyone. DeAndre, can you see this Google Sheet / Excel spreadsheet?
I see it.
Right. So I'm going to give this to everyone so you could download it, right? So I'm just going to be real with y'all. If you don't have at least $5,000 in your account, stop trading. Go focus on making some more bread in your profession. Go make some more money and focus on that so that you can have an account size where the risk actually makes sense, right? Because if you're only trading with less than $5,000, it's going to be hard for you to trade anything, stock options or penny stocks, which have more risk associated with them. So I kind of made this chart for you, and I modified someone else's chart and kind of did my own thing, right? So if I put in $5,000, right, what happens? It adjusts, right? So if I'm risking 2.5% per trade, then my potential loss per trade is only $125, which means my maximum budget is $500. Which means if I'm sizing up correctly or scaling in, then my budget might only be $150 for the aggressive level. And that might mean you can't trade options that are more than $1.50, right? That are more, well, because it's $1.50 times 100, because each contract equals 100 shares. So if your option costs $1.50, then that's going to cost you 150 bucks. That might mean you are only looking at stocks where the options are less than, 150 bucks or $1.50 per contract, right? And then your conservative level, right? That might mean you can only buy total like 3 contracts to get into a full trade, right? Or a full position in your particular trade. And that's why I said if you're less than 5 grand, it's going to be hard for you to do this. And especially even if you go down to like a 1% risk, that's even more difficult, right? So I would suggest starting at least with an account with 5 grand in it, or go get your bread up. You don't need to be trading. You need to get your savings up and figure that problem out first before you start trading, right? Because 5 grand, I think, is the least amount you can start with, where you at least have enough shots on goal, enough at bats to where if you have a system with some edge, it's actually going to make a difference, right? And so with this sheet, you can do that. Let's say if I'm starting with a larger account with 100,000, right? And then I want to risk less, and I want to risk 1%. This is going to show you what your budget is, right? If you have a 100,000 account, if you got a $10,000 account, and you only want to risk 1%, this is going to show you what your budget is per trade, right? And if you're a cowboy and you want to risk 5%, it's going to show you what your budget is, right? And so I built in all of these formulas to kind of show you what's what. And depending on your trading style, and for me, I might be going based upon guide 1 or guide 2. It just depends on what the market is doing. The market has been more choppy lately. We were coming out of September, and October isn't usually a great month. So I mostly, if I want to take an aggressive or a moderate entry, I'm only going to put 30% there. And then if it gets way lower, then I might put 70% of my budget on the trade, because it's just a better trade at that particular point in time. It's more exhausted, it's more likely to go up or down depending on if I'm trading calls or puts on that particular day. If we're in a more trending market, then I might have 3 separate entries into a trade to get on a full position. This is how I was trading a little earlier in the year, but lately I've been finding that this is better for me and for my emotions and my mentality, is having 2 entries. Having an aggressive or a moderate entry where the volume spike is, and I haven't been seeing more than 2 volume spikes in my zone where I've been picking up options. So I would rather have an aggressive or a moderate entry and a conservative entry rather than 3 entries to size into a particular trade, right? That's just me. That's how I'm trading now. So I will put this in the notes or in the description of the video, so where you can download this from my site. So that way you can go punch in your account size and your desired account risk and figure out how much you should be risking per trade. So if you see me trading, generally on my aggressive level, it's going to be around 1,400 bucks, and at my conservative level, it's going to be around 3,200 bucks. That's how I'm going to be sizing into a particular trade, right? All right, let's go back. And so just to show you how I mark things off on my chart in terms of scaling into a trade, right? This was, I think this is XLF. I'm currently in an XLF trade right now, right? So I had an aggressive level, I had a moderate level, and I had a conservative level. And I think I got in somewhere between the aggressive and the moderate level on this trade. My conservative position almost got put on, but it didn't quite hit my trigger. So right now I'm only in an aggressive moderate position in this particular stock because it didn't hit this bottom level. It was very close, right, where I'm drawing the volume spikes, but it didn't quite get there. So my conservative leg didn't get put on in this particular trade, just to show you how I'm marking off my levels. For version 2, someone who wants to get in 3 separate times to scale into a trade might buy some options here with 25% of their budget, buy some options here with 25% of their budget, and then buy some options here with 50% of their budget, right? And number four, you want to have a good risk reward ratio in your trade. That's how you manage risk, right? And so I wanted to show you this in terms of where my target is for this particular trade. This is still XLF, right? It's one of the trades and one of the sectors that I think is strong right now. So I put this trade on Friday. Just looking at my target and the risk reward, as you can see, if you enter in the moderate level or the conservative level, the reward is far greater than entering in at the aggressive level, right? If you enter in here, this is your reward. But if you enter here, you got all of this to get your reward. You have more room for your option price to become more valuable, or your stock price, depending on what instrument you're trading. But this is your reward. So you want to be entering in at better risk reward ratios, which is why I'll put 50% or 70% of my budget here on the conservative level, because that's a better risk reward ratio, right? There's just more room for this to go up. And candidly, I'm actually looking at this top right here as potentially my target one. I know it's drawn here. This is where the top of the entire move, it was the most recent high was. But I looked at the volume levels. There's a lot of volume right here. So if I'm at 25% gain, which is like a 1-to-1 risk reward ratio, I might scale out a half of my position around right here if we get to a 25% gain in my option price, right? So just showing you how I trade, right? So I might get out right here, and ideally I would rather get out right here because this is where the most recent high was, where I think there's probably going to be some selling pressure or a lot of selling pressure once we get to this top line right here. But candidly, on Monday, I might move my target here, more so specifically because we do have some big things reporting next week in XLF in terms of MasterCard and Visa, which have been propelling XLF. So on Monday specifically, if we hit this target right here, this top, that might be where I actually start scaling out on my position. And by scaling out, I mean selling half, right? With that said, we're going to get into some of our weekly stock picks for this week coming up in our sectors. And once again, what I tell people is when I give you these names, I am not telling you to go out on Monday and buy these things at whatever price that they're at. My strategy is to buy these things when they are exhausted. So I like trending names that have a really bad day. And that's going to be my entry point, is when they have a really bad day or a red candle. That's when I want to hop into this trade or any of these trades. So with the disclaimer, for everyone out there on YouTube or on the Zoom, this is for informational and educational purposes only. This is not financial advice. This is not investment advice. I am not a licensed professional. I am an attorney that happens to trade in my spare time. Trading, excuse me, trading is risky. So do so at your own peril. As I stated earlier, even my strategy has a 30 to 40% loss rate. I am anticipating losses. So do with that as you will and do your own research, right? So the app that I use to figure out what's trending is Koyfin, Koyfin. That is one of the apps that tells me what the sectors are doing. I typically go try to find what the sectors are doing over the last 30 days and figure out what's hot. So just looking at what's hot over the last 30 days in terms of percentage, we have semis, SMH, XLF, which is financials. As I told you, I'm already in a current trade. KRE, which is the regional banks. XLK, which is tech. And XLC, which is communications. Those are really the only places that I'm going to be in. I'm not going to be in some of these names that aren't up as much. With the exception of the commodities, which is gold. GDX is gold miners. I'm currently in a trade from last week because this was a sector that was hot last week. But the commodity is different from GDX, which is actually the gold miners, right? So, SPDRS, the spiders. I have to get you the link. This is another thing like Koifin. It just looks a little bit different. And once again, it's showing you what sectors are hot over the last month. David, can you pick her up, please? What sectors are hot over the last month? Over the last month, once again, we have financials, XLF. That's why I'm currently in an XLF trade. I caught it on a pullback on Friday. My secondary sector is tech. I'm in a trade. I'm in a trade right now with Cisco and Apple because tech is pretty hot right now. I'm potentially going to be out of my Apple trade because it reports earnings on Thursday. So while I'm in an Apple trade, I'm probably going to be out before it reports earnings on Thursday this week. And then we got communications this week, right? And so those are the three sectors that I want pullbacks on this week primarily. What I'm looking for potentially to keep going up that might come on my list is energy. It had some really good days last week, but it's still kind of sideways long term. So this isn't on my list yet, but if this goes up, then energy might come on my list next week. Industrials was on my list last week, had a bad week, and it's kind of sideways now as well, and has some, I believe, some companies reporting this week. So that's why I have it as yellow, caution, where I'm going to be looking at this for potentially coming on my watch list either at the end of the week or next week, depending on what it does this week. And what's on my list that I don't want to trade to the upside would be healthcare and consumer staples. XLP and XLV is the worst. If I were to short anything, I am not shorting anything because the entire market has been up. But if I were to short anything, I would be shorting healthcare. But even with healthcare, they have Eli Lilly reporting this week, which is a big portion of XLV. So if I were to short something, I would probably try to get out before Lilly's earnings reports later this week, right? So here are the particular names that I would that I am going to be looking at or that I'm already in. On Friday, XLF, BAC, and MasterCard. MasterCard is off my list this week because it reports this week, but those all triggered Friday. They all had significant pullbacks. Instead of taking Bank of America, though, like my class that I'm in took, I took XLF because I would generally prefer taking an entire sector because it's safer than taking an individual name. But I am already in an XLF trade, but Wells Fargo looks good, Bank of America looks good, and JP Morgan looks decent. Almost in that order, that's how I would trade them, right? And just to show you my sector watch list, right? To show you why I'm in this sector. Number one, I showed you Koifin and that other chart from SPDRS Select Sector site. I think I'm saying it right. I'll get the name for you and put it in the notes of this this YouTube video, right? But look at XLF. Strong trend, bullish trend. You see we're making higher highs, which tells me that this stock is trending. This is a version of the 34 exponential moving average, and as you see, it's trending upward, which means we have an upward trend in the financial sector. I created this chart using the flexible grid, and you see these other names that are on my list. The big banks are doing pretty well right now. So you got Wells Fargo that I think is the most bullish because it keeps making higher highs, right? So this would be number one on my list. But on Friday, it didn't pull back, so I didn't enter Wells Fargo. Actually, here's my alert where I wanted it to pull back. It didn't quite hit it. It almost got there, but it didn't, right? So I like Wells Fargo. I like XLF itself, which I'm already in. This one pulled back enough for me to get in on Friday. I like JP Morgan. It's making some newer highs, but I actually prefer Bank of America over JP Morgan because this one looks a little bit more bullish. JP Morgan looks a little bit more range bound, right? But those are my three. I love MasterCard, but it's reporting this week. Goldman Sachs, I think I looked at the options and they weren't that liquid or they were really expensive. Same thing for Morgan Stanley and BlackRock. They either weren't that liquid or they were really expensive. So I do like this entire sector, which is why I took a trade on the entire sector last week. The next, we're looking at tech, XLK. And you did see SMH or the semis up there, but there's some cautionary tales with SMH this week because AMD is reporting. And so, like, as well, and I'm going to show you the entire chart. I like XLK, I like Cisco, I like Oracle, NVIDIA, and TSM. I am currently in a Cisco trade right now. And here is why. Look at XLK. It's bullish, right? We're making higher highs, right? That's what I want to see to make sure that we're trending. And I want to see this exponential moving average moving upward on a daily chart. Apple, that's why I'm in this trade right now. It was trending. We were making higher highs on Apple, but it reports earnings on Thursday. So I'm going to try and be out of this trade before it reports earnings. I like NVIDIA making higher highs, right? So that's why it's on my list. I don't like Microsoft. It's reporting earnings this week as well, but it's more sideways than it is making higher highs. Because look at this high right there. It hasn't broke it. So Microsoft is not on my list. Same thing for AVGO, AMD. CRM would be on my list, but I didn't find a bunch of liquidity, or it was either the liquidity or the options prices were too high. I like Oracle, same thing. And I'm in Cisco right now too. This is actually one of my favorites because look at the curve of this exponential moving averages, right? It's trending the most. That's why I hopped in this thing on this pullback on Friday. So I'm in a Cisco trade, but that's why I like the tech sector in general, right? Actually, what looks the worst in the tech sector is Adobe. But I still wouldn't short this because the entire sector is up. The entire sector is up, even though this is in a negative downtrend. It's likely to rise more than it is to keep going down because it has to fight against this entire sector in order to keep going down, right? SMH, so we're talking about chips inside the tech sector. The reason why, like, even though SMH had the highest percentage growth over the last 30 days, the only two names I'm interested in is NVIDIA and TSM, mostly NVIDIA, because NVIDIA is also heavily weighted in XLK, right? So in SMH, like, the entire sector doesn't look that great, right? The only names that have been propping this thing up has been NVIDIA and TSM, but AVGO is sideways, ASML is down, Qualcomm is sideways, Texas Instruments is sideways, Micron is sideways, AMAT is sideways, LRCX is down, AMD is sideways to down, and Intel is sideways, right? So that's why until this thing, like, if SMH breaks this high right here, which is around 262.5, then I will become more bullish on the entire sector. But I'm also waiting this week on some big earnings reports before I really start taking SMH to the long side, right? Commodities, the only thing that's on my radar is gold, but only the GLD ETF, not GDX. GDX, even though I'm currently in a GDX trade, GDX looks worse than gold itself right now, the commodity. And this is the thing that's kept hitting. It's been working. So I might decide on this particular stock or this name. This is the futures, right? That's tied to GLD, the ETF. Instead of taking the aggressive levels on this because gold is so extended, I might wait until a pullback to a more conservative level before entering because gold has just been up and on a tear for the last few months. And I'm concerned that the trade is becoming a little overcrowded, right? So in terms of news next week, I'm not going over Fed speak and employment numbers. I think there are some unemployment numbers coming out at the end of the week, right? What's mostly important is we got a lot of major names reporting this week that might move the entire market up or down just because these are like the mega caps, right? Google on the 29th, which I think is Tuesday. Visa on Tuesday, really heavily weighted in XLF. Google heavily weighted in XLC. AMD heavily weighted in XLK and SMH. And on Wednesday, we got Microsoft, Meta, and Lilly. Microsoft heavily weighted in XLK, Meta heavily weighted in XLC, Lilly heavily weighted in XLV, the healthcare sector. October 31st, Halloween, we got Apple heavily weighted in XLK, Amazon heavily weighted in XLY and XLK. MasterCard heavily weighted in XLF financials, and then Uber heavily weighted in XLI. And then on November 1st, we got Berkshire Hathaway reporting. We got ExxonMobil reporting and Chevron reporting. So this is the energy sector. Here's a big component of XLF and the financial sector, right? That's where we got with earnings. So now I kind of want to talk about execution of what we were explaining at the beginning of the class, which was how do you set a stop loss, and number two, what was it? How to set a stop loss, and kind of showing you a little bit about risk reward ratio, even though we kind of went over that. But let me go stop sharing this and pull up Thinkorswim, which is the platform that we use, right? So if I'm in a trade right now, which I am in 6 trades right now, right? So let's say XLF, what's down the most? GDX. This is my worst trade at the moment, right? I'm down $281 on this trade. So if let's say I want to set a stop loss on this, right, at a particular level, and I want it to be 25% of the price where I purchased it. Oh, here it is right there, right? So I purchased this option, 13 of these options right here, 13 contracts at $2.10. So once again, you saw my sizing chart, right? So I have a 25% stop loss. So really, I want to sell this if it goes down by 25% or more. The way that I would calculate that is I would put 210 times 0.75. So my stop loss should be at $1.57. So if I want to go set a stop loss on this particular option, I could do it in 2 separate ways, right? So what I would do is I go to trade. I'm going to go pull up GDX options, where the one that I traded the 41 strike. I'm going to copy the option chart. All right, go to chart, pull up the option chart. And so for the second way that I set stops, I set a stop loss alert. It's already here at $1.62, which is 5 cents more than my stop loss. I essentially want my platform to notify me if we're getting close to my stop loss. So I set an alert. So in order to do that, you right click on your chart, pull this over, click create an alert, and then you can do when the mark is at or below 162, it's going to create a stop loss just like this if you click that create button, right? So that's how to set a stop loss alert. If you can't get to your platform, you're busy that day, and you want to automate it, the way that you could do that would be to either go to the, where is it at? GDX. Oh, actually, let me pull back up the option chart, right? Go to the option chart, and then I could click the bid to sell, right? 13 of these, which is how many contracts that I entered into. Instead of setting this as a limit order, I could sell it as a stop order, which will be a market order, which is what I was talking about earlier. And then make sure it's at the price of 25%, which is $1.57. $1.57. And then either you can have it good till cancel or just for the day, depending on how you trade. If you never want to look at it again, you could put good till cancel. I always do it at the end of the day, just because I would rather set my stop losses every day if I'm automating it. And actually, I would rather prefer to do a stop loss alert so that I can have a more precise way of getting out of a trade in case I am trading an option that has more than a 2% difference in the spread. So this is actually a particular stock that I would be comfortable automating my stop loss because the spread is only 2 cents. So if I have a market stop, I'm only going to lose 2 cents when I get out, or $2 per contract. So for 13 contracts, $26 is going to be my max loss in the slippage if they get me out right here at 188 versus 190. And so when we get to $1.57, this will probably be like $1.57, and this will be like $1.59 if the spread stays within like 2 cents, right? So that's what I'm looking for. And then if I click confirm and I click send and we go look at our chart, you're going to see it automatically automated a stop loss right here, which is kind of below. And then that's where the market is closed. So like, I think this is probably going to be a little further down on Monday in terms of where the stop loss is. But this is automated where essentially, and if I actually go pull up the option chart, you see my stop is directly on the option chart where here's my alert and my stop is just below the alert. That's how I would automate my stop loss on an option, right? So 2 ways to actually execute your stop loss. Either have an alert here, or automate it if you can't get to your platform. So where if this option price drops all the way down here, it's just automatically going to sell and get me out, right? So that's how you actually execute a stop loss. And in terms of position sizing, so if we go to XLF, because that's where I have my example. Let me actually go to an hourly chart so you can see it better, right? So if I wanted to place orders at these particular levels, what I could do, if I go, this is the strike price that I'm in at XLF, it's at 148 or at 46 bucks. It's currently trading at $1.48. So if I wanted to scale into this option at a particular level, what I could do is, in fact, it's always easier for me to trade directly on the option chart. Pull up the option chart again. And let's say I wanted to get in, I usually actually have 2 charts open. So let's say XLF, let's put that here. Oh, actually, let's put that here. And then the option chart here. Right? So if I wanted to scale in, it looks like I bought this at $1.50. That was my price to get in XLF. That was probably my aggressive level. So what I could also do is, let's say I wanted to get into 13 contracts at the moderate level. Let's say that was my aggressive level. Let's say my moderate level is here. Actually, that's more of conservative. Let's say it's like here. Actually, it's more here, right? Let's say that's my moderate level. And we could also have, so I usually double up if it's further down at the conservative level. So I would do like 26 contracts. This is just a hypothetical, everyone. I might put that at like around there, right? And remember, options pricing is not static. These are always going to move, especially as time goes forward. So I would rather put my entries to buy a little lower than my levels, because when time decay happens, this is going to lose value anyway. So this might move up a little bit. But as you see here, I have a volume spike here. That's why my conservative level is right there. And it didn't hit it. It went right above my volume spike level. And I got in, I think, around right here where there was another volume spike. And this is where I was saying I'm generally picking one aggressive or moderate level to enter and then a conservative level. So on this particular one, I saw the volume spike. This gray area is my zone where I want to buy. I saw a volume spike right there. So I got in around 46.80. I bought some options, and then I was waiting for it to get down to 46.50, but it didn't quite get down there. So I didn't get into like my second position on XLF. And that's just showing you how I trade things, right? So I'm going to click this to kind of get out. Come on. There we go, right? To cancel my trades. And that's how I would execute it. personally in terms of getting in a trade or setting my stop loss. So we pretty much hit the end of my presentation for today. DeAndre, you got any questions? Anything you want to look at?
All right. So obviously, of course, let's look at Tesla.
Oh,
And
my favorite stock, of course.
hmm
I'm being facetious, everyone. Facetious, everyone. I typically hate Tesla, just because the reason. So, I don't. I hate Tesla for two reasons. Number one, I know that everyone says they're a tech company, but they're a car company, and they're trading at a extremely large multiple for just being a car company. And yes, their sales are up. If you looked at their earnings report, typically we'll go look through our earnings report. My next, just because we got a bunch of mega cap earnings next week, I might actually go over a couple earnings reports next week to kind of talk about fundamental analysis, which is more important for long term investing versus trading. I don't really care about fundamentals for trading as much. I do care about fundamentals for long term investing. I don't like Tesla's fundamentals for long term investing. And I drew this last week. It's still within this range. It's been trading between 150 bucks and 300 bucks for like a year and a half now, right? So that's why I don't like Tesla from a long term standpoint, because there have been many things that have been hitting new highs over the last year and a half that I think would be a better vehicle for your money. That's just me personally. From a trading standpoint, Tesla is just hard to trade because it's not really tied to much of anything except for XLY. I feel like it moves on its own. The market could be down and Tesla's going up. The market could be up and Tesla could be going down, even with the tech names. So it's hard for me to get a beat, to get like a beat on Tesla in terms of what it's doing. So that's why I don't trade it. Right now, it's looking like it's exhausted to the upside. So, not that I would short anything right now in this market, but it looks like it's exhausted. I definitely wouldn't get in right now. If you're a momentum trader, you would. If you're a momentum trader looking at this high right here, let me draw a line. If you were a momentum trader, you would probably have a limit order past 271 to buy if it breaks this, right? But I don't trade momentum. I would prefer to grab this around that 200-day moving average again, right? You look at all of these lows right here around 216, 215. That's where I would prefer to pick up Tesla on a swing, because I like things when they're bouncing off their 200-day moving average. So if Tesla comes back down and fills this gap at 220 or below, that's when I would rather pick up Tesla for a swing. Long term, if I were to buy this as a long term position, I wouldn't get in until Tesla comes down to 160 to 150, right? That range. Even closer to 155 would be better, because that's been the range it's been bouncing off of long term. And I would rather grab this in my long term portfolio when it's more discounted at like 150 bucks, so I at least can swing it all the way back up to 300 bucks worst case scenario, and then hold it, and then hopefully it finally punches through this zone at 300 bucks and keeps going higher. But to me, like, it's going to have to impress more with its earnings, its sales, uh, for the market, I think, to believe it's going to go higher than 300 bucks. But that's my analysis on Tesla. It's cool, but you
and
would have
then
made
now,
a you would have made a lot of money like Isaac did if you would have took a flyer and gambled on earnings. But I don't gamble. I try like Isaac be gambling. I'm just be real. He be gambling because look, Tesla could have done two things. It could have went up like it did, or it could have dropped. It was a 50-50. It was a coin flip. You would have been just as well going to a roulette table and betting on red or black at the casino. On earnings. I get out of my trades before earnings. Specifically, I was talking about NEM the other day. I got out on this day. It reported earnings after hours. I got out on this candle, I think, right here. And I think I scaled out here and then got out at a little bit better than break even on my remaining position, because I didn't want to sit through earnings. And what happens during earnings? It tanked. I would have lost a ton of money if I would have stayed in that trade. So this is like just showing you Earnings is a coin flip. Don't trade a coin flip. You don't have an edge. I like to trade things where I have an edge. If I don't have an edge, I'm not going to get in. Yes, you could have made a ton of money with Tesla if you would have traded it on earnings, but if you would have did the exact same thing on NEM, you would have lost. So I like liken that to going to the casino. Go to the casino if you're going to be gambling. Yeah.
Let's check out Meta.
Meta has been sideways, but it also reports earnings next week. So I like Meta as a swing trade because it's trending. I like XLC in general because this is a big component, a major component of XLC. And look at the trend on XLC. The only reason why this is not on my list this week is because the two largest components of XLC are reporting earnings this week, and Google and Meta. But if I had to trade this or not that, I would trade Meta over Google. But I do like Meta. And once again, if you were entering from a IRA long-term position, I would rather catch it closer to its 200-day moving average. This is generally where I would try to buy a leap or buy some shares. And my long-term position would be around 490 to 486 bucks, around that area. From a technical standpoint, if we zoom out and go to a weekly chart, what did I say? 400. Did I say 490? Yeah, that looks like a good level right there. Where is it? 490. Just because if you look at how many times things hit that level and bounced off, once, twice, 3 times, 4 times, it straddled it here, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, 19, 20, 21 times. That's a really good level. So I'm just looking at where price is bouncing off of it in the past, right? And go back to a day chart. Look at that. All of these times it's responding to this level. So around in between, I would say if you don't want to risk it not getting all the way down there, in between like 495 and 485, if we're talking about a zone, because that's usually how I trade. Like I show you, I scale into positions. That would be the zone that I would start scaling in. I might start scaling in around 495 all the way until it gets down to like 485. That's where I would be trying to scale into a position on Meta. For a long-term buy or like buying leaps, which is what I do in my long-term accounts from time to time, that's where I would grab Meta for an investment standpoint. But then also we got to look at its earnings coming up, I think on Wednesday or Thursday. What does it report? Is it still doing amazing? Is ad revenue falling off? How does it react to earnings? And just looking at the history of Meta, because it's been up so much, it's going to have to report a really good earnings beat for this to keep going up, because we were already recently at all-time highs. So this is one where the expectations are going to be really high. So sometimes you have stocks that report earnings that beat their estimates but barely beat and go down. I would say Meta is a candidate for that. If it barely beats its estimates, its revenue estimates, and its earnings per share estimates, Meta could go down even with some decent news. But I feel like Meta is going to have to have a really big beat on its earnings estimates for it to go higher than its all-time high around 600 bucks. That's how I would analyze Meta. All right. Anything else you want to look at before we leave?
That's it, my guy.
All right. My baby is crying in the background. Mokama Sunday service, making it rain without the umbrellas. Next week, we'll probably be talking about one of the Magnificent Sevens that's reporting, whether it's Apple, Microsoft, Google, Amazon, Lilly. I'll probably be going over earnings reports in details in terms of fundamental analysis. If you want to be on the Zoom, shoot me a comment, a DM, let me know. And we'll be back here 8 a.m. every Sunday. See y'all later. All right. Peace.
All right, my guy. Stay up.
Deuces.